Are you worried about the 2025 potential housing crash and how it might impact your wealth? Maybe you've tried following general investment tips or listened to financial experts, but they haven't provided specific strategies to protect your portfolio from the looming housing crash. In this video, we'll dive deep into Warren Buffett's warning on the housing market, reveal proven strategies to safeguard your investments, and show you how to turn this crisis into a golden opportunity. By following our advice, you'll gain the insights you need to protect your assets and even capitalize on market downturns. Consider how Elon Musk, a visionary entrepreneur, turned challenges into opportunities by strategically investing during downturns. His calculated moves in tough times have propelled him to immense success. Like Musk, you too can use this market turmoil to your advantage if you follow sound investment principles. This is the Next Millionaire Channel, your premier source for personal finance and wealth-building wisdom. So, let's dive into this amazing content. 1. Understanding market declines. Navigating market declines can be intimidating, but it's an essential part of investing. Historically, markets experience a correction, a decline of 10% or more, approximately every 2 years. Additionally, bear markets, characterized by declines of 25% or more, tend to occur about every 6 years. This cyclical pattern is a fundamental aspect of investing that savvy investors prepare for. To understand this better, think of the market as a living, breathing entity that goes through cycles, just like the seasons. Just as winter inevitably follows autumn, market corrections and bear markets are natural parts of the financial landscape. When the market experiences a decline, it's akin to a seasonal change, unavoidable but manageable with the right preparation. The key is to anticipate these downturns and have strategies in place to handle them effectively. Investors who fail to recognize this pattern often react impulsively when the market drops. Instead of panicking, use these declines as opportunities to reassess and realign your investment strategy. Understanding that market declines are normal can help you stay calm and make informed decisions rather than emotional ones. 2. The importance of knowing what you own. When the market takes a dive, it's crucial to understand the fundamentals of your investments. Peter Lynch, a renowned investor, famously said that knowing the intrinsic value of your investments helps you stay grounded when prices fluctuate. If you invested in a stock because it was undervalued at $14, a drop to $6 should not necessarily prompt you to sell, especially if the company's fundamentals remain strong. Imagine you're a detective uncovering clues about your investments. You need to examine the company's balance sheet, earnings reports, and overall market position. For example, if a company with a strong balance sheet and solid cash flow sees its stock price fall from $130 to $100, it might be a signal to investigate further rather than jump ship. If that same stock continues to drop, your job is to dig deeper and determine if the decline is due to temporary issues or fundamental problems with the company. By understanding what you own, you can avoid making decisions based on short-term market movements. This approach helps you identify real opportunities amidst market chaos, ensuring that you only sell investments that no longer align with your long-term goals and not merely because their prices have fallen. 3. Strategies to safeguard investments during a crisis. Protecting your investments during a market crisis requires a well-thought-out strategy. Here are some key tactics. Diversification. Spread your investments across various asset classes, stocks, bonds, real estate, and commodities, to mitigate risk. Diversification acts as a safety net by reducing the impact of any single investment's poor performance on your overall portfolio. For instance, if the stock market falls, your bond investments or real estate holdings might still perform well, balancing out your losses. Emergency fund. Keep an emergency fund that covers 3 to 6 months of living expenses. This fund should be kept in low-risk liquid assets such as a high-yield savings account or short-term treasury bills. An emergency fund provides a financial cushion during market downturns, allowing you to avoid selling investments at a loss to cover unexpected expenses. Rebalancing. Regularly review and adjust your portfolio to maintain your desired asset allocation. For example, If your portfolio was initially split 60% in stocks and 40% in bonds, a market decline might shift this ratio. Rebalancing helps you stay aligned with your risk tolerance and investment goals, ensuring that you're not overly exposed to any single asset class. Long-term perspective. Maintain a focus on your long-term investment goals. Short-term market fluctuations should not derail your strategy if your investments are fundamentally sound. Remember, investing is a marathon, not a sprint. By staying committed to your long-term goals, you can weather short-term volatility and benefit from market recoveries. Applying these strategies can help safeguard your investments and even create opportunities during a market downturn. The goal is to build a resilient portfolio that can withstand market fluctuations and capitalize on favorable conditions when they arise. 4. The role of volatility in investing. Peter Lynch had a unique perspective on market volatility. Rather than fearing it, he viewed volatility as an opportunity. High volatility often leads to significant price swings, creating potential buying opportunities for investors who understand the underlying value of their investments. Think of volatility as a storm that shakes up the financial landscape. While it may seem disruptive, it can also clear the way for new growth. For instance, during the 1970s, Taco Bell's stock plummeted from $14 to $1. Despite the sharp decline, the company had no debt and a strong business model. Lynch saw this as a chance to buy undervalued shares. Eventually, Taco Bell was acquired by Pepsi-Cola for $42 a share, significantly higher than the price Lynch paid. Embrace volatility by staying informed and being ready to act when opportunities arise. By focusing on the long-term potential of your investments and understanding market dynamics, you can turn periods of high volatility into profitable opportunities. 5. Patience and long-term investing. Patience is a critical trait for successful investing, especially during market downturns. Peter Lynch's experience during the 1987 crash underscores the importance of maintaining a long-term perspective. Despite significant short-term losses, Lynch's commitment to his long-term strategy led to substantial gains over time. Imagine investing as tending to a garden. Just as plants take time to grow and bloom, investments require time to reach their full potential. Short-term market movements are like weather changes that can impact your garden temporarily, but they don't dictate the long-term health of your investments. By staying patient and focused on your long-term goals, you can avoid making rash decisions based on short-term volatility. Patience also involves resisting the urge to constantly monitor and react to market fluctuations. Instead, focus on your investment strategy and allow time for your investments to mature. By doing so, you can ride out market downturns and benefit from long-term growth. 6. Learning from history. Studying historical market trends provides valuable insights into how markets recover from downturns. History shows that while markets do experience declines, they also recover and grow over time. For example, despite numerous market corrections and bear markets, the long-term trend of the market has been upward. Think of historical market trends as a map guiding you through uncertain terrain. By understanding past market behaviors, you can better navigate current challenges and anticipate future opportunities. Historical data reveals that markets have consistently rebounded from declines, offering a reassuring perspective during periods of market turbulence. Learning from history also involves recognizing patterns and trends that can inform your investment decisions. By applying historical lessons to your strategy, you can make more informed choices and prepare for future market conditions. 7. Seizing opportunities. During market downturns can present lucrative opportunities for investors who are prepared. During periods of decline, high-quality assets may become undervalued, creating potential for significant gains when the market recovers. Consider downturns as a sale on the stock market. Just as you take advantage of discounts during a sale, use market declines as an opportunity to buy quality investments at reduced prices. For instance, during the 2008 financial crisis, many high-quality companies saw their stock prices drop significantly. Savvy investors who bought these stocks at lower prices were well positioned to benefit from the subsequent market recovery. To seize these opportunities, conduct thorough research and identify companies with strong fundamentals that are trading at discounted prices. By investing in these undervalued assets, you can position yourself for future growth and capitalize on market rebounds. 8. Learning from the greats. How top investors thrive during crises. Examining how great investors have navigated market crises offers valuable lessons. Take Robert Kiyosaki, for example, who became a billionaire during the 2008 financial crisis. Kiyosaki's approach to the downturn demonstrates the power of leveraging market conditions to one's advantage. During the 2008 crisis, Kiyosaki focused on identifying distressed assets and properties that were undervalued due to the economic turmoil. He leveraged his knowledge of real estate and finance to acquire these assets at bargain prices. For instance, he purchased properties at significantly reduced prices, knowing that the market would eventually recover. This strategic buying allowed him to amass substantial wealth as property values rebounded. Kiyosaki's success was rooted in several key steps. Educating himself. Kiyosaki invested time in understanding the real estate market and economic conditions. By staying informed, he was able to identify opportunities that others might have missed. Maintaining liquidity. He ensured he had sufficient cash reserves to act quickly when opportunities arose. Liquidity allowed him to purchase assets without having to sell off other investments at a loss. Adapting strategy. Kiyosaki adjusted his investment strategy to take advantage of the crisis. While many investors were fearful and hesitant, he saw the downturn as a chance to buy undervalued assets and expand his portfolio. Long-term vision. His investments were driven by a long-term perspective. Kiyosaki understood that while the market was down, it would eventually recover, and his strategic purchases would appreciate in value over time. By following Kiyosaki's example, you can learn how to turn market crises into opportunities. It's about educating yourself, maintaining flexibility, and having a long-term vision for your investments. This approach can help you thrive even in challenging economic conditions. In conclusion, safeguarding your investments during a market crisis involves understanding market cycles, knowing your investments, and applying strategic principles. By embracing volatility, maintaining patience, learning from history, and seizing opportunities during downturns, you can navigate market downturns effectively and turn challenges into opportunities. By applying these insights and strategies, you can build a resilient investment portfolio and position yourself for long-term success. Remember, market downturns are a natural part of investing, and with the right approach, you can protect your assets and take advantage of favorable conditions. Quick reminder, if you're finding this information helpful, make sure to hit that like button and subscribe for more content like this. Share your thoughts on how you're preparing for the housing crash in the comments below. Quick quiz time. What's one of the most important strategies for protecting your investments during a market crisis? Is it A, diversification, B, panic selling, or C, ignoring market trends? Drop your answer in the comments below. I'll reveal the correct answer at the end of the video. If you found this video helpful, please give it a thumbs up, share it with friends who might benefit, and subscribe for more insights on personal finance and wealth building. Here's a bonus tip. When investing during a crisis, consider focusing on sectors that are less sensitive to economic downturns, such as utilities or consumer staples. These sectors often provide more stability and can be a safe haven for your investments during turbulent times. The correct answer is A, diversification. Diversification is crucial for protecting your investments during a market crisis because it spreads risk across different asset classes, reducing the impact of any single investment's poor performance on your overall portfolio. So that's it, folks. Stay focused, stay motivated, and keep pushing forward. The next millionaire is you.